So you want to trade the wheel strategy, but you don't have enough money to cash secure a put on Nvidia or Apple or Amazon? Well, today I'm going to run you through my favorite stocks to run the wheel strategy on for 2026 for small accounts and how I would build a small account portfolio using diversified products. What are the stocks that I have to trade the wheel strategy on for 2026? I made a short list of different products that include large cap, small cap stocks with growth potential, and some ETFs to give you a wide diversification. I will go into them one by one, but before we get started, let me just show you what are the key criteria that we have to pick stocks to trade the wheel strategy on. Number one key criteria to trade the wheel strategy is you want liquid options. You want tight spreads so that you can get in and out of positions easily. You don't want, as a small account, to be paying a lot to the market makers and have wide spreads like more than $20. Imagine you are making $40 or $50 premium in a position. If you are leaving on the table $20 just because of the spread, that's a huge portion of your premium. So always select liquid options to begin with. You want stocks that are priced in between something like $10 and $100. You want to avoid the penny stocks, so nothing below $5, and you want to have liquid options, usually $10 to $100 a good range. More than $100, well, it will capture too much of your account, and you don't want to tie up too much on a single position. Criteria number 3 is you want a quality company. So you want to trade the wheel strategy on companies you believe in. Companies that are profitable, companies that are growing, companies that have a competitive moat. You don't want to trade it on companies that are on their way to bankruptcy, on companies that are not growing. Please select companies that you are comfortable to own. Always remember, the key to trade the wheel strategy is select stocks you are comfortable owning. Lastly, you want to choose products that have some volatility. Now, some of the ETFs might have slightly lower volatility. That's acceptable because you are trading, in that case, IV or premium to have a smoother ride because you have inherent diversification. But mainly when you are trading single tickers, select products that have some level of volatility. Now, you don't need IVs above 100, but you don't want to select IVs of 15 or below 15. Usually I like to trade products with IV at least above 20. That gives a decent amount of premium. You can expect with IV around 20 to look at annualized return of about 24%. So you can keep that in mind. Your annualized return, if you are targeting about 20 to 30%, you need IVs above 20 to 25. Okay, let's dive into the products. The first product I'm going to talk about is Ford. So Ford is very well known. I think almost everyone that trades the wheel strategy started with Ford or traded Ford at a certain point. It's a low price stock. You can use it to trade several contracts. And if you look at Ford right now, it is on a good pattern. It is moving up over the past 1 year. Over the past 6 months, is consolidating at these high levels. So I like to see this type of pattern. Long term momentum is up. Shorter term sort of consolidation. And if you look at the financials, Ford was in a bad spot a few years ago, but right now Ford has a pretty meaningful dividend. Ford has been growing, and you can see quarter to quarter pretty decent revenue. Annualized, you can see the growth in the revenue. Always like to see that. It's not a company that is stagnating. It's not a company that is losing its profitability. So Ford is a pretty decent defensive stock that you can have in your portfolio. Next up is Pfizer. So Pfizer is another one of the defensive stocks I'm going to talk about today. Pfizer is a really large company, one of the biggest pharmaceuticals. If we look at Pfizer, it's a little bit different. It has been trading range bound over the last 1 year. Actually, I don't dislike this type of situation to trade the wheel strategy on. You see, it has been going down, then goes back up, goes back down. So it gives you a situation where you can sell your cash secure puts. You might get assigned, but then you sell your covered calls. You might get assigned again, and you make some profit on both sides, on the stock side and on the premium that you collect. So It's a pretty good product. It's a really large company. Once again, if we look at the fundamentals, it's another one that has a pretty meaningful dividend at 6%. This is really good in case you get assigned. It means you can get this dividend and in that way reduce your cost basis. They profit a lot from COVID, so that's the increase in revenue that you see here. And then, of course, that decrease when the COVID vaccine revenue stopped, essentially. But they have recovered. They are at levels now that are pretty good compared with 2020. So if we exclude the COVID revenue, the company has been growing at a decent rate. Price to earnings is about 15. It's really a pretty decent company that you can use as a defensive stock in your portfolio for a very low price. Each cash secured put will cost you about $2,500. Then the last defensive stock I'm going to talk about is Bank of America. So Bank of America is one of my single favorite stocks to run the wheel on, and it has been so over the past few years. You can see that over the past 1 year it has just been going up. It seems now to be finding some consolidation zone. So I very much like Bank of America at these levels. It just came from earnings and it is finding its consolidation after earnings. I would definitely sell a cash secured put at these levels in here. If we look at the fundamentals of Bank of America, once again, you have a nice dividend. You have a really large cap, a meaningful PE that's not too high for the sector. And if you look at the revenue, Bank of America has been increasing revenue a lot. Over the last year, revenue did not really increase, but they were still able to increase earnings. They were able to navigate the situation of the inflation and the change in interest rates. You have exposure to several sectors of banking, direct lending, and investment banking, and is really a stock that I'm happy owning for the long term. Moving on to slightly more speculative products, we have NU or Nubank. Nubank is a Brazilian neobank that has been expanding all over Latin America. They have gotten expansion in Colombia and in Mexico that is now bringing some revenue, and they just got conditional approval from the US to form a national bank. So it's a stock that is poised for growth. It's a stock that is not such a large cap like the previous ones, but it has been growing a lot over the past 1 year, as you can see. In terms of fundamentals, this is not a stock with a dividend yield, and you can see that it's much higher price to earnings ratio. But if we look at the growth, you can see the growth quarter to quarter has been impressive. You can see if we look annually that we went from a really small cap stock to what is a meaningful bank today. And the revenue has been increasing massively, and they have been able to increase their market share and penetrate new markets. And it was only in Brazil up to a couple years ago, and as you can see, expanding to Mexico, Colombia, and is going to expand to the US. I expect it to continue expanding. So this is more of a growth stock to try to maximize your returns. Use it in combination with the more defensive stocks. Another stock more on the growth side is SoFi. So SoFi is a payment and personal lending type of company, a fintech company. SoFi again has been increasing a lot in price over the past 1 year, and it has been consolidating over the past 6 months. Reality is, in the last few days, SoFi has declined a lot. I would not sell a cash secured put on SoFi at these levels. SoFi needs to find its footing right now. It needs to potentially at this zone of the 20 to 22 handle, it needs to consolidate around that zone. If it consolidates, then I would look to sell a cash secured put. Right now, this might keep dropping. I would not sell a cash secured put in here, but it's still a company I like for the long term, and I would keep it on my watch list as a company that can also help us maximize our returns, more of a growth company. SoFi is also a company that has been growing a lot. You can see here quarter to quarter, once again, the revenue growth, the annualized growth. However, the reality is that SoFi has a very high P ratio, so it will be a very volatile company, and it is really a growth stock. So once again, use SoFi and use Nubank in combination with the more defensive options that we've got. Next on the list, I have my ETFs. So I'll go into a few ETFs. ETFs can be really beneficial because they allow you to have diversification that you simply do not have the purchase power to afford with a small account. I picked up 4 ETFs that have relatively low price and can give you different types of exposures. My favorite one is EEM. So that's iShares MSCI Emerging Markets. Emerging markets have been on a tear over the past 1 year. You see here we have a 30 to 40% increase in a 1 year time frame. The reality is that it's due to diverse factors. One of them is the dollar has been weakening. Mainly that is this recent push up. But also the companies have been really performing well. And if we dive into what emerging markets include, well, it includes a lot of different things. And some companies that I really like Taiwan Semiconductors, Samsung, SK Hynix, all these companies in the semiconductor space are super key players in the semiconductors. And as you know, the semiconductors have been on a complete tear, and so it's a very cheap way to get exposure to these extreme large caps from South Korea, from Taiwan. It also gives you some exposure to China and Middle East and some other different places. So I really like the emerging markets. The volatility will be slightly lower, but is a good opportunity to diversify and not have concentrated risk. It gives you opportunity to also have electronic technology, finance, technology services. You see all these different sectors inside the one fund. Next up, I have 2 sector funds. One is XLF and the other one is XLE. Both of them are pretty interesting. It depends what type of allocation you want to have. In the case of XLF and XLE, you are selecting a sector in this case. XLF, that's financials, and XLE is energy, both inside of the S&P 500. But in this case, you have an allocation to one sector that will include at least 10 companies, and it gives you diversification. So it reduces the risk of a single point of failure, that is a single company. You can choose which type of allocation you want. XLE has been increasing a lot over the past week. I would wait for this to stabilize a little bit, but you can see the performance is pretty decent. XLF, on the other hand, increased a lot about 1 year ago and has been stabilizing over the past 6 months. I would very much trade XLF at these levels. One thing to keep in mind is I wouldn't trade both XLF and Bank of America at the same time. They will have very much overlapping returns, so pick one or the other, whichever you like. Bank of America will have slightly higher volatility, higher premiums, but more concentrated risk. XLF has more diluted risk, but premiums will be slightly lower. Last that I have is FXI. FXI is iShares China large cap. So China market is still growing and it might be always a little bit volatile, but reality is the price is very low for this ETF and it gives you a very wide exposure to companies like Alibaba, Tencent. It gives you exposure to AI plays, to banks, to all type of companies. And the performance is really what I like to see to trade the wheel strategy on. We see growth over the long term and we see consolidation over the short term. So at these levels, I would really like to sell a short put on FXI for my small account trading. Last stock that I'm going to talk about is ONDS. ONDS. This is a little bit an outlier of everything. So this is not really a profitable company. ONDS is a small cap stock, less than $5 billion. But is a stock really poised for growth. I believe in this stock long term. You can see it's a stock that has come from under $1 to trade to for more than $10 per share. They have really interesting contracts with the US military. They are making drones and telecommunication equipment. This is a stock that even though it has small market cap, you can see the average volume is crazy at about $100 million per day over 30 days. Of course, if you look at the fundamentals, this is a really small stock and is not a profitable stock. So you can look, they've been burning through cash. Quarterly, they increase slightly their revenue, but they're still burning through money. They have very interesting contracts for the future, but it's an execution risk. Use this sparingly or pick stocks that you actually like, and this type of stocks can maximize your returns because the IV is really high, but do not allocate more than 5 or 10% of your portfolio to these small cap stocks. Use them sparingly to increase your returns, but be very careful that these type of stocks might always go to zero. Okay, so we went through all the stocks that I have to talk about, my favorite stocks for 2026. So what are some general rules? Well, rule number 1, you want to avoid earnings. Do not make this an earnings play. Earnings are binary. The stock might go up, but the stock might go down a lot. I would avoid those, and I would avoid starting positions into earnings. Second one is you want to sell puts at values you are comfortable owning. Usually I look to sell 30 delta to balance risk and reward and 20 to 45 days to expiration, because that's when volatility and theta starts to pick up and you can maximize your returns. But if the stock has been on a tear and is at very high prices, and even at 30 delta put you are not comfortable owning at that values, just ignore that stock for a moment. Wait for it to consolidate, wait for it to be at prices you are comfortable owning. You don't want to go into stocks that are just falling down, but you also want to avoid stocks that are on a tear and then they might need to come down to consolidate and you might be back holding for a while. So pick your poison and select stocks at values that you are comfortable owning. Lastly, I aim for IV ranks and IVPs above 20%, but usually below 80%. When it's above 80%, the market's pricing in some risk that you don't understand. Either there's a fundamental risk with the stock, either there's a company event coming out or some earnings coming out. Always be very careful. If IV rank or IV percentile is above 80%, the market's pricing something's wrong. Okay, I would like to run you through how I would build a $20,000 portfolio to trade the wheel strategy for small accounts. I would pick several stocks. I would pick between like 3 and 5 positions, not really more than 5 positions, so that you have some diversification, but you don't have a ton of positions and you can focus on the more meaningful opportunities that exist. So for example, here I'm picking up Bank of America and NU. So they are both financials, one more on the growth side in Latin America and a very big bank, one of the biggest banks in the US. And this would correspond to about $9,000 or about 40% of my portfolio. Then I would add XLE and FXI as 2 funds, China-based fund and XLE based on energy, and they give pretty decent premiums, and I would allocate to funds about 50% of my portfolio, be it XLE or FXI or XLF or the emerging markets. I would try to allocate about 50% to these diversified funds. I would try to allocate about 40% to more mature companies like Bank of America or Pfizer. I'm not picking right now Pfizer or Ford because they have earnings in the next days. So right now they are not good place to have. That's why I have a little bit over allocation to the financials. But after earnings of Ford and Pfizer, I would include them and maybe get rid of NU, for example. It all depends on how things are looking, and this needs to always be considered depending on the technicals at that stage. Lastly, I would pick up one stock that I believe in for the long term that is more a growth stock. In this case, I'm choosing ONDS. I'm picking just one contract, 5% of the portfolio, and this is really kind of your kicker option to try to maximize your returns. So we can see here that our total premium is about $379. We are using $19,200 of cash, so we are utilizing 96% of the portfolio. This gives us a premium of 1.9% per 30 days to expiration, so it annualizes at about 22%. Then you have these cash secured puts, and to maximize your returns, you can use box spreads. If you don't know what are box spreads, click on my video that I'm linking up above, and I will explain how you can use box spreads to increase your returns by 3 to 4%. So easily you are looking at about 25% annualized returns, and that is the double of the long-term S&P 500 returns. So just think how this simple strategy can maximize your long-term returns compared with the S&P. Last thing I want to talk about is some risks and mistakes that people do while trading the wheel strategy. The first one is having either too many positions, so taking positions where there isn't a real opportunity, or using leverage. Leverage can be really risky. If you are 2 times levered and your prices come down 20%, well, your portfolio will see minus 40%. And then if you are a beginner and you aren't really confident on your trading plan, it's really hard to hold for the long term. You'll probably just sell, you'll panic, and you'll realize a loss that you cannot take back. So start without leverage, start small, get confidence on the strategy, get confidence on your trading plan, and then you can increase the stakes time by time. Second one is chasing very high IV or meme stocks. High IV is can be really dangerous. So one of the biggest things for me in the beginning was choosing stocks that I really didn't want to own just because they had high IV. And then the reality is the stock drops. I'm uncomfortable having this stock because I don't care about it. And then I end up selling. I book in a loss, and I'm not really trading the wheel strategy at that stage. I'm just trading short puts and speculative. So choose stocks you want to own and avoid chasing high IV. And last thing is earnings plays. Earnings are binary and they can be really dangerous for small accounts option trading. So be careful around earnings, and my advice is mostly avoid earnings, at least at the beginning. That's my favorite stocks to trade the wheel strategy on for 2026. If you have any questions or you'd like me to cover any other products, please comment below, and don't forget to like and subscribe. Cheers, everyone.